The last type of transactions for inventory in this chapter are inventory gains and inventory losses. So, at any time of any day, a trading firm needs to know exactly how many units of inventory it has. So we looked at this example earlier where we said this is a bookshop. It's a new book called Sea Tranquility. It says over here there's 7 units, and if you click on there, you can actually go and look up in real time. It says there's 9 at the Southland store, there's 6 at Geelong, and 1 in Camberwell. And you can do the same for JB Hi-Fi. You can look up this video game here and it will tell you where it is available and where it isn't. And every business now pretty much has a version of this that you can look up online. Well, that is part of what's called the Perpetual inventory system. And we looked at that earlier and we said it's got 3 main parts. The first part is it's a system of recording inventory that never stops. As soon as there's a movement of inventory, either in or out, we record it continuously and without ceasing. And that's like those websites. They update automatically once some units come in or go out. Secondly, the firm uses inventory cards to record these continual movements of inventory, and that's what we've been doing. We've been learning how to record all these transactions in inventory cards. And then I had this third bit, which is what we're up to now. At the end of the period, a physical inventory count is done to determine if any inventory was lost or gained during the period. So that's what we've got to look at. So if we were to look at this here, it says there should be 6 at the Geelong store. So they'll have an inventory card on the computer that will say, it'll have the name of the book and a code and so on. And it says here there should be 4 at 10 and 2 at 5. I'm just making these amounts up, but there should be 6 units. And that's what the inventory card is. So when you look up the computer in a shop, that's the inventory card. And it shows what should be there. There should be 6 copies of this book according to this inventory card. But that's only what should be there. What we need to do is actually do an inventory count, and that shows what's actually there. For example, maybe there's only 4 books there and 2 are missing. Or you could actually end up with more. Maybe there would be 7 books there. But the point is we should actually count how many units of inventory are actually there. And that is what's called an inventory count. It's a physical count of the number of units of each line of inventory the business has. You might see the term stock take. That's also the same thing. And it's done at the end of the reporting period to check whether the inventory cards are correct. So if we were to say this is a year, when would you do an inventory count? Well, it's up to the business. But basically during each month, you're relying on the inventory card to tell you how much inventory you've got. So whenever a customer comes in and wants to know this or that, how many units there are, you're looking up the inventory card. But then at the end of the period, depending on how long your reporting period is, let's say it's a year, you will shut the shop down, you'll get your staff in, and you will count up the inventory. So once upon a time it was done by hand, like this guy here, so it used to take forever, but now we have barcode scanners and stuff like that. So even in a store like Kmart, where there's hundreds of thousands of units, you can just scan it and it will count it. But the point is we're physically counting every unit of inventory. And when you think about that, that is a massive job. It takes a lot of people and time. So most businesses probably only do it once a year, maybe twice a year. So in the middle of the year and at the end. But you can do it whenever you want. So quarterly, you could even do it monthly, although monthly would involve a lot of work. You might just see in the real world these signs all the time, stock take sale, everything off. What does that mean? It just means that, and you start to see it sort of around about late June and late December often, it just means that rather than count it, so they've got a stock take coming up, and instead of counting it, which is a pain, they'd rather sell it. So they reduce the price, so then they don't have to count it later. So that's what a stock take sale means. So the result of the inventory card will either be perfect. What do we mean? The inventory count will count the exact same number of units as what the inventory card says there is. So we take those books, the computer or the inventory card says there were 6 copies of the book, and we count 6 copies. We might though get an inventory loss. What does that mean? It means the inventory card says there's 6 copies of the book, but we only find 4. So we've lost a couple. Or we might even gain inventory, which doesn't seem logically like it would happen, but it does. What does that mean? It means we should have 6 copies of the book, but we count them all up and physically count each item, and there's actually 7 or 8 or whatever, more than 6. So we can summarize now what this is about. What is an inventory gain? It is when the inventory count shows more units than the inventory card. So we've got more than what the inventory card says. And the opposite is for an inventory loss. That's when the inventory count shows less units than the inventory card. How can this happen? You might be asked to give some reasons. Well, let's take inventory gain. How could you gain more units? You could have oversupply by suppliers. A supplier delivers 20 units when they are meant to deliver 15 units. Well, how can an inventory loss happen? We can have the opposite. Undersupplied by suppliers. Let's say you were meant to get 12 units, but the supplier only delivered 10 and didn't pick up the mistake. You'll have lost a couple. How else can this happen? Well, you can have an undersupply to customers will give you an inventory gain. What does that mean? A customer buys 3 units but walks out of the store with only 2. Maybe they leave a bag at the register. Well, what happens to that inventory? It just goes back in stock. So there's an undersupply to customers. But the opposite could happen. You go into a store and buy 2 units of something, but the staff actually accidentally put 3 units in the bag. It's called an oversupply to customers. We've got one that's called stock taking errors. Maybe when you were counting everything during the inventory count, you just counted wrong, or like wrote down a 3 as an 8, so you could use that for either an inventory gain or an inventory loss. And also for an inventory loss, we've got probably the most obvious one, which you probably use first if you ever get asked this question. Just say theft or damage, either by customers or staff. That would probably be the most common cause of an inventory loss. But we have lots of reasons. What else do we need to know? How are each of these classified in the financial reports? Well, an inventory gain is a revenue and an inventory loss is an expense. So why is it classified this way? Well, we just go through our definition. Let's start with a revenue. Why is an inventory gain a revenue? 1, because there is an increase in assets. The business has gained inventory, and inventory is an asset. What about with an inventory loss? Why is it an expense? Because instead of an increase in assets, there's a decrease in assets. The business has lost inventory. What else makes these revenues and expenses? Well, the second part is a revenue. This one here will result in an increase in owner's equity, and this one here will result in a decrease in owner's equity. And lastly, they both have the same third characteristic. They both arise in the course of the ordinary activities of the business. In other words, this one's not a capital contribution and this one's not drawings. How do you get an inventory gain or an inventory loss? Well, just from opening the store every day and running it. So they both occur during the course of ordinary activities. So why do we need to perform an inventory count and how often should we do it? Well, we've got this qualitative characteristic called faithful representation, which says the information reported must be a faithful representation of the real world. And that just means that the information's got to be complete, free from error, and neutral. So what's that got to do with this? Well, we could say an inventory count is done to ensure the financial records of the business are accurate and free from error. And this ensures faithful representation. The balance of inventory that we're going to put in the balance sheet should reflect reality. So it should reflect the actual amount of inventory on hand in the real world and not just what the computer says or the inventory card says. So the business should perform an inventory count as frequently as it possibly can based on the amount of time and wages involved. So if we've got lots of people and money, we should do this pretty regularly. But if we don't, maybe we won't. It also depends on the type of inventory the business sells and how easy it is to count. So take Bunnings with like nuts and bolts and screws, which are stored individually in some of those shops. That would take forever. If it's a car yard, that's so much easier. So that's going to sort of factor in it too. But as a minimum, we've got to do this yearly because we need to update our inventory to its actual real world balance. So how should we value inventory gains and inventory losses? Well, that's the last little topic we've got to do. And there's, like all our transactions, 2 methods. There's either the identified cost method or we're going to use first in, first out, or FIFO. So we'll look at each of those now.